Is it possible to invest well without having to give up cash when you need it? To understand an investment portfolio with liquidity is a set of financial applications that can be easily and quickly converted into cash without significant loss of value. Liquidity indicates how fast you can redeem the invested money and have it available in your account, and it's crucial for those who want access to financial resources in the short term. Some people think investing means locking up money for years, but what if I told you it's possible to strengthen your portfolio and still maintain liquidity? If you don't know me yet, I'm Chad from Zero Markets, guys, and today you're going to understand how smart investors do this and how you can do it too. In this video, I'm going to show you how to build a portfolio that grows over time and at the same time allows quick access to money when necessary. We're going to talk about strategy, but in a simple way, with practical examples, analogies, and decisions you can apply today. Many beginner investors fall into the trap of all or nothing. Either they lock everything in long-term products or they keep everything in a checking account out of fear. But there's a middle way, and it's called liquidity balance. Think of an investment portfolio like a house. You don't have to live only in the kitchen or only in the bathroom. You need balance between the rooms. Understand that an intelligent portfolio has layers. Layer 1, immediate liquidity, treasury bonds, savings account with daily liquidity. Layer 2, planned liquidity, fixed income funds with redemption in D+1 or D+2. Layer 3, growth capital, stocks, REITs, ETFs. This structure allows you to have access to money in emergencies without giving up on growing your wealth. Do you want to understand more about these layers? Comment below with the word layers and we'll bring more details soon. Here's a practical example. Imagine you have $50,000. $15,000 stays liquid and it keeps earning. $20,000 in short-term investments and $15,000 more in volatile assets. Results? Freedom plus growth. Now let's talk about common mistakes most people make when building an investment portfolio without liquidity. Right, the first mistake is leaving everything in savings accounts, ignoring redemption deadlines, investing in products with lockup periods without understanding the risks. The truth is that lack of strategy can turn liquidity into a loss of value. Liquidity without intelligence is just idle money. When you understand that a portfolio needs to breathe along with your life, everything changes. You stop thinking only about return and you start thinking about security, autonomy, and freedom. So before locking or unlocking everything, ask yourself one simple question. Will this investment help me or hold me back? Enjoying this content? Then subscribe to the Zero Markets channel. You're going to enjoy the videos we post here weekly with context, clarity, and real strategy.